monthly macro webinar for July 2024, focused on growing but slowing. I think if we think about what has happened with the U.S. economy in particular over the course of the last, say, 6 to 12 months, there was an extended period of time where there was concerns about whether the U.S. economy would continue to expand. If you go back just at the beginning of this year, interest rates were priced to cut 6 or 7 times. The bond yield was as low as 3.75 on the 10-year. Analyst expectations for U.S. growth in 2024 was something close to 1%. And all of that in the face of what had been the most stimulative financial conditions over the previous 8 to 12 weeks that had existed in 40 or 50 years. And at the time, if you check out our outlook to start off the year, we said stronger for longer was the outlook. So while the markets were pricing in quite weak economic conditions and Fed tightening, we were saying the conditions were lining up for a stronger for longer economic environment. And that really played out significantly over the course, in particular, of the first quarter and to some extent in the second quarter, where stocks outperformed bonds and where the priced in cuts into the interest rate curve at 6 to 7 faded to as little as 1, with even some talk at one point a couple of months ago about whether the Fed's next move might be to hike. That was a big shift. The primary reason why that shift occurred was there's a big shift in expectations, U.S. growth expectations. That's what you see here on the right-hand chart, which, there's lots of different ways to look at this, but I think economists' consensus expectations for growth is a pretty good way to look at it, pretty simple measure to look at. And what you see there is a rapid shift in economists' expectations in terms of U.S. growth for 2024 from that 1% to kick off a little bit below, all the way up to 2.4%, and just ticking down here in the most recent period. That was a remarkable shift. Now, I think a lot of folks, you might look at equities and you might say, hey, look, stocks are up because of AI measures or big tech, big mega cap tech, et cetera. As a macro investor, I look at the world through the growth and inflation lens. And of course, within an equity market, there are winners and there are losers. But from a macro lens, what happened in the first half of the year was actually quite normal, which is there was an upside growth surprise in terms of expectations. Stocks rallied, bonds sold off, the dollar strengthened. It was a pretty good, and as those expectations shifted. Now, what's happened here, which I think is an important dynamic, is whenever you're thinking about trading markets, you're always thinking about what is likely to transpire relative to what's priced in. And so when we look at things like the equity market today, what we see is priced in is for a continuation of very strong growth, the sort of very strong growth that we saw over the course of 2023, the second half of 2023. And that is unlikely, given the set of circumstances. That level of strength is unlikely given the dynamics that we're seeing in the economy. And those dynamics are, the continued elevated interest rate environment is continuing to grind on economic activity on an ongoing basis, and it's continuing to slowly weaken economic conditions. This isn't an acute crisis like 2008 or something like that, or even a bubble bust the way we saw in 2000. This is in many ways a very normal, cyclical, late cycle slowdown in response to a significant tightening environment. And that's basically what we see here. Fred Eric over at EPB Research does a great job creating these sort of timely and comprehensive coincident growth measures. And here you see in his work, just showing that shifting down of what's going on in the economy from very strong in 2022 to pretty strong in 2023, running, in the ballpark of between 2 and 3%. And then really over the last 6 months, what we've seen is a shift down to something like 1-ish%, 1 to 1.5% real growth in the U.S. economy. Now, that's not bad. 1 and 1.5% real growth in the U.S. economy is probably enough to generally keep labor markets in pretty good shape, not deteriorate the unemployment rate rapidly. And it's, good enough to keep the economy going to some extent. But what it isn't is consistent with expectations of booming growth that have been priced in to analyst expectations and to the stock market. And so that's what you see here. If you just take 2.3% growth over the course of 2024, which is currently expected, with first quarter GDP at 1.4%, and you take for granted basically the Atlanta Fed measures, which are about 1.5%, give or take. If you put that all together, and that's for the second quarter, what that would imply is that expectations are that in the second half of the year, we're going to have one of the greatest, growth booms that we've had in the post-COVID environment. And that is improbable given the momentum that we're seeing in the economy. Doesn't mean that we're getting a recession. It just means the odds that we get such an elevated growth environment seem unlikely ahead. And we see this in a couple different ways. The slowdown, I think in particular, looking at the consumption measures, I think are very interesting along this dynamic. First quarter GDP showed a moderation of consumer spending contribution to GDP growth, moving down to about 1% in terms of contribution. That's about half of what it was in the second half of last year. And then you're also seeing in more timely measures, for instance, in the personal consumption expenditures, you're seeing those measures pretty flat for the second quarter. Those measures just growth on their own about 0.8% annualized for the first 2 months of the second quarter that have been reported. We'll find out the rest at the end of this month when the full GDP report comes out. But odds are we'll see personal consumption be, pretty modest over the course of the second quarter. And again, part of that general gradual deceleration that we're seeing in the economy. At the same time, on the flip side, we've talked a lot about, if you've been around here long enough, you've heard me talk about the income-driven expansion. And so the labor markets are very important very important linchpin in terms of continuing to drive the macroeconomy forward and to continue to get, reasonably good spending and growth. And what we've seen there is not a significant weakening of the labor market, but we have seen some moderation across a number of different measures in the labor market. Here showing the timeliest measures seen with the claims data. The initial claims data, which is a good indication of the rate of firings, is still pretty stable relative to, where we've been. The thing that we're starting to see is that continuing claims data. It's starting to creep up. It's low in any absolute sense, but it's starting to creep up, reflecting the fact that some folks are feeling a little bit more challenge in moving from unemployment back to employment. So the lengthening of the duration of employment. Now, these are the sorts of things that, this is not a fast-paced recessionary curve. In order to see that, you'd have to probably see a much steeper curve over there on initial claims with firings, but it is indicative of some softening of the overall labor market. And I think, the basic dynamic, if you look under the hood, looking at the JOLTS data, is it's not a slowdown. It's not a significant slowdown driven labor weakening. What we're seeing more is essentially just a hesitancy to hire. So what we're seeing, quits, soft relative to history, about at the pre-COVID rate. And we're seeing firings, that's layoffs and discharges. Those are at the pre-COVID rate or maybe just a touch below. Both of those would indicate that, there's not a lot of, labor's not really moving around very much. Companies are fine with the labor that they have. The main area that's the outlier is that the hiring rate has moderated to some extent. And so that's what you're seeing here. On the left-hand side are the quits and layoffs and discharges, and there on the right-hand side is the hiring rate, which is, low relative to the pre-COVID pace noted in the line there. And as a result of the slowing of growth, the slowing of employment growth, we're basically seeing a slowing of nominal demand. And so we've talked at length about how this is an income-driven expansion. that income is being driven by continued employment growth as well as wage growth. But those elements are softening, like we talked about last month. And so we're seeing this sort of gradual softening of nominal incomes down to about 5%, give or take, on an annualized growth basis. And that's corresponding with a softening of overall nominal consumption, which is also growing about 5% at this point. So that puts us in an overall dynamic: nominal growth about 5%, nominal spending about 5%. That's not a terrible environment for economic conditions ahead. It's just certainly not consistent with a significant growth acceleration that's being expected, for instance, in analyst expectations. And that's really the outlier here. And it's, it's challenging in these sorts of environments because, when it's clear that there's a direction that the economy is going in terms of moving to a quick recession or moving to a boom, and a lot of times you can follow the momentum and you don't have to get too worried about exactly what's priced in, because the momentum by itself is sufficient to tell you, which direction to go. In these late cycle environments, it's a bit different. Most of us haven't seen these late cycle environments, but if you go back and study the ones in the 50s and the 60s, and you study them across countries, it's very normal that you get in a late cycle environment growth that continues but starts to moderate as the central bank tightens in response to elevated inflation pressures. But expectations, which are almost always based on backward-looking experience, continue to expect relatively strong growth just as the economy is slowing. And so what we see here amongst analyst expectations in the equity market is very consistent with that sort of very classic late cycle dynamic. If we look at the equity market, we look at, in this case, S&P 500 EPS, over the course of the last 8 quarters, it's basically been flat. There's been a lot of movement under the hood in terms of who is gaining and who isn't. But the big picture is 8 quarters, flat earnings. But when we look at how analysts are expecting to see earnings grow over the course of the next 12 to 24 months, they're expecting a boom in earnings growth. 17% year-over-year earnings growth expected by the end of the fourth quarter, and a combination of near 30% earnings growth over the course of by the end of calendar year 2025 in comparison to calendar year 2023. Those are huge numbers, huge earnings growth that are expected, particularly in light of the fact that we've had basically flat earnings growth over the course of the last couple of years. Just to draw some perspective on that, if we look at how earnings growth has played out over the course of the last, couple of cycles, it's not unheard of to have earnings growth in sort of the mid double-digit range, even for a couple of years. The thing that's unusual about it is that it would happen at the late cycle rather than coming out of a bottom. So we have seen earnings growth consistent with what's expected. For instance, coming out of COVID, coming out of the financial crisis, and after a lot of effort coming out of the tech bust. But in no cases have we seen earnings growth persist at that level for multiple years in a late cycle environment. And so what is being expected is basically very strong earnings growth at a time when the economy is slowing in response to the tightening. The only way, the way that this can work is basically either need a margin, you either need sales growth or you need margin expansion. And I think that's very important to think about when you're thinking about how could, for instance, 17% earnings growth be achieved. Well, at a S&P 500 level, the big picture story is that S&P 500 revenues are generally going to move with GDP growth in the US and then to some extent abroad, because about 40% of sales are abroad. And that nominal GDP growth is probably going to be 4 or 5%. In fact, analysts will pencil out 4 or 5%, have penciled out 4 or 5% for revenue growth over the course of the next couple of years. So basically penciling out with nominal GDP. the thing that is driving such an elevated expansion in earnings expectations is margins which have been flat, although close to near highs over the course of the last couple of years, are expected to rise 2.5% to be higher than any time in history over the course of the next 2 years. Now, a 2.5% margin increase over the course of that's margins going from about 12 to 14 and a half or something like that, or 12 and a half up close to 15. That's a heck of a margin expansion that's being expected by analysts. And so the question is, how can that get achieved? How can you get such an incredible margin expansion in an environment where you're very late cycle and labor markets are pretty tight? It's hard to see how that will play out, because classically, in order to get margin expansion, someone in the economy has to dissave. Because if you get it through labor margins, as a simple example, what ends up happening is if your revenues are a function of the spending of the spenders in the economy, so consumers primarily, although to some extent businesses, and your costs are associated with the incomes paid to the consumers in the economy. And so you can't get a margin expansion for free. It can't just happen. Some people will say, hey, look, there's going to be a productivity boom, so margins are going to expand. Okay, that doesn't work. It doesn't work that way. And people who went back and learned this in the tech bust, that's not how it works. Because if the productivity doesn't flow to incomes, then the spending available doesn't happen. And as a result, the top line revenues can't be achieved. And so someone in the economy has to dissave. The question is, who will dissave? Households have been very conservative with their dissavings. Businesses are disinterested in dissaving or borrowing, given the current level of interest rates. And the government is already running relatively extreme deficits, particularly in light of cyclical conditions. And so that's the main question that has to be answered is, how will such extreme margins get achieved in light of the fact that that is the only path to get the sort of extremely elevated earnings expectations that are currently priced in. Now, if we turn our attention to inflation, obviously a lot of information that came out today got a lot of focus with a slightly weaker than expectation inflation print. I think from the Fed's perspective, when you look at that dynamic, inflation has printed a couple of soft months. We have seen soft months in the past revert. There's some real questions about whether we're seeing true disinflation or simply or how much of it is being impacted by seasonal measurement issues, which overstated the inflation earlier in the year and maybe understating the inflation this year. We saw a similar pattern happen last year as well. I think the basic question is, given the circumstance where we have inflation that, even with a couple of weak prints, is still elevated relative to the Fed's mandate, and we have an environment where, while we're seeing some softening in labor markets, we're not really seeing an acute softening in labor markets. If you look at, for instance, prime age working percentage, so the percent of prime age population that are employed, it's basically at secular highs and has been flat for 18. That's not an environment that requires swift cuts to be delivered by the Fed. And so while there is certainly some desire from the Fed to normalize in their words, not in mine, to move interest rates down if we get easier inflation, on the concern that there might be weaker dynamics in the labor market, odds are that this whole process is going to move a lot slower and be bumpier than the sort of straight line expectations that are currently expected in the markets. I mean, just look at what we see here on services ex shelter, which ultimately arbitrage to wages. Services ex shelter, there's lots of details under the hood. that in terms of exactly how it gets measured. But at a big picture level, services ex shelter is a function of either input costs like oil prices, basically oil prices and gas prices, or wages. Well, what we've seen is 2 months of extraordinarily low services ex shelter numbers. Notably, we saw the same very, very low set of numbers emerge last summer over the course of the same months, raising the question about whether there's some sort of seasonal issue here. And in a way that, to be frank, is implausible. This sort of shift from being elevated, from running at 4 or 5 or 6% to running at basically zero over the course of 2 months. That's not how price growth works in the economy. And if you look and triangulate other measures of inflation, core inflation, surveys, consumer expectations, things like that, there's basically been no change over the course of the last year. And so much more likely that what we're seeing here is noise in the data rather than big shifts in the reality. And so you put that together with the fact that wage information continues to suggest that wage growth will remain elevated in comparison to pre-COVID levels, and where we're seeing productivity continue to be mediocre, productivity growth to be mediocre at best. These numbers are through the first quarter. The second quarter is going to basically be the same: 1.5% growth, 1.5% employment growth. That's 0% productivity. An environment where we're seeing wage growth, say ECI, at 4 to 5%, and at the same time we're seeing zero productivity growth. That combination is not a combination that's going to lead to a significant wage disinflation. While some numbers have come down, things like average hourly earnings, many of those numbers have composition issues, and they're more reflective of the shifting composition of incremental employment than they are a reflection of the shifts in overall wages. Big picture is wage growth is growing a couple points higher where we were pre-COVID, and productivity growth is growing weaker than where we were pre-COVID. In addition, the numbers today were significantly reduced by a low OER or shelter print. That was an unusual print. While we've seen some of the measures of market-based rents, particularly new tenant rents, falling, the all tenant rent index has continued to remain elevated. That's what you see here over on the left-hand side. Has continued to remain elevated, and today's numbers were an outlier relative to the reference all tenant rental rate index that is published and generally leads on a smoothed basis the type of rent growth costs that we're seeing. And so you look there and you sort of say, look, that the services ex shelter number looks, these look relatively significantly weak compared to what's been happening in the period before. It's a big shift. You look at the rent numbers, they look soft relative to the reference index. The main point here is, in no way would you sort of sit here and say it is certain that inflation's beat. And I'm sure the Fed is prudent enough to recognize that, sure, on the margin, the balance of the pressures are now, the pressures are now more balanced between, inflationary pressures and labor. But what that doesn't mean is, enter a huge cutting cycle necessarily. And that's to be clear, when you're trading the markets, again, you have to be looking at things relative to expectations. And as we look at expectations today, we've already priced in something like 150 cuts over the course of 150 basis points of cuts over the course of something like a year. Is that possible? It's certainly possible. But you look at this balance of pressures, and it certainly doesn't look like the type of pressures that would typically align with a very rapid set of interest rate cuts. With twos at 4.15, they are pricing in very weak conditions and a rapid set of cuts in a way that is not necessarily consistent with either the pace that the Fed would typically move in an environment where there's, only modest employment shifts, which are likely to stabilize, and an environment where inflation certainly remains modestly above their mandate. So not really clear what the urgency is for the Fed to move, given the circumstance. Now, does that mean they might cut once? They might cut twice through the end of the year? Yeah, who knows? They might do one or the other. That's basically what the market pricing is. Not that it hasn't been that interesting for about a quarter now. But the question more broadly is, are we entering an aggressive easing cycle? That aggressive easing cycle is what you have to believe will happen. Actually, what you have to believe will happen is that the Fed will be even more aggressive than what's currently priced into this curve if you're thinking that bond yields at their current rates make a lot of sense. Coming to bonds, not only do you have to believe that the Fed will cut faster than 6 times over the course of the next year to be buying bonds today, you also have to believe that term premiums in bonds will have to go even more negative than they are right now. Bond yields at 420 indicate a negative term premium. That's the premium of holding long-term bonds relative to cash is essentially zero. You're getting paid nothing to hold the risk of buying a long-term bond relative to cash right now. And so when you think about buying bonds, you basically break it into two pieces. You can say, how is monetary policy going to play out relative to what's priced in? Remember, fast cutting cycle currently priced in. And then what's the premium I get on holding long-term duration relative to cash over the course of the next 10 years? That is basically at post-COVID or post-crisis lows. And the U.S. economy today is very different than where it was in the post-crisis era. The strength of balance sheets and the risks of inflation to the upside are all the sorts of things that are meaningfully different than where we were just after the financial crisis. As a person who traded through the financial crisis and afterwards, the macroeconomic conditions today couldn't be more different than where we were in, say, 09, 10, 11, 12, et cetera. And the term premium on bonds is the same today as it was back then. And that doesn't make a whole heck of a lot of sense. That particularly doesn't make sense in the context of the continued supply dynamics, which will be in place while the Fed has slowed its it's slowed its pace of QT through the rest of the year. Notably, what has entirely offset that is the fact that the deficit is coming in larger than expected. So now we're starting to see a deficit based upon the June 2024 forecast, which is likely to be, 1-ish, maybe a little bit more percent bigger as a percent of GDP than was expected before. This is very important from a bond supply dynamic. Even if the deficit had stayed stable, there would have continued to be a substantial amount of bond supply, duration supply into the market. But the primary determinant of whether that will change and whether it'll pick up will be a function of the overall deficit. They said that in the last QRA, that it's likely to be stable unless the deficit is larger. Well, the deficit's going to be larger, and the bond issuance is likely to be larger as a function of that. We'll learn about the Treasury financing plans a little bit later this month. But odds are, given the restate of the U.S. government budget deficit, that's likely to be substantial. And look, we can talk about this quarter or that quarter or the next quarter, but the big picture is, with debt levels the way that they are, and with issuance the way it's going to be, basically no matter what ends up happening, we're going to continue to see a massive supply of borrowing come into the market by the government. And that constant flow of borrowing is going to continue to put pressure on the yield structure. And so, eventually the deficits will not be, lenders will no longer accept a zero term premium environment in order to continue to be buying that debt. In addition, when you think about the risks of how that might change ahead, and particularly how the markets might perceive those risks, it's very important uh, to think about a new administration or the continuation of the existing administration in the context of how much of whether their administration will exist with split government or with government with a party holding all the houses. And increasingly, as a function of the political machinations, it looks like the probability that the Republicans will hold all three chambers is rising relatively substantially. This is from a few weeks ago. At this point, the presidency is priced in at roughly 60% to the Republicans. The Senate, the newest estimates I was seeing before starting this are almost, are in the 80s. And the House also pricing in the 80s. You put that together, and you have almost a 40% chance or probability that the Republicans will hold all three chambers of Congress, or all three chambers of the legislature. And that's very important because what it means is if they're able to do that, then they're able to run the policies that they desire rather than being constrained by having to work in a bilateral way. And so, it's not really clear, it's still a toss-up, let's say, in terms of at a big picture level, in terms of whether Democrats or Republicans will be elected for the presidency for sure. But what we do know is both parties and both candidates that are currently running have had relatively substantial, relatively clear track records of running substantial deficits. And the odds that we're going to have a bunch of fiscal consolidation come into the market, regardless of who is elected, is pretty low. And you can see that there with a little bit of humor on the right-hand side. I think the big question for markets increasingly will be the control of all three chambers by the Republicans. And if that becomes more clear ahead of the election, we could start to see that affect what's going on in the asset markets. And we saw just the tiniest hint of that in the debate and how bonds traded through the debate. And that could just be the start of the dynamic if it becomes increasingly clear that Republicans will control all the chambers. At the same time, we're seeing these relatively lofty expectations of U.S. growth and of significant cutting cycle. We're starting to see dollar liquidity start to tighten globally. And probably the best way to describe this is financial conditions. And financial conditions is always a very, very hard thing to understand. But when you think about financial conditions, what they really are is the combination of the desire for the private sector to buy assets either through their own income or leverage, combined with the public sector, meaning central banks buying of assets. And typically what you see, if you look back through time, is that the assets on the edges, the most speculative assets, often are the ones that feel a tightening of financial conditions first. And often what you'll see when financial conditions are tightening is that it's not just one asset that's being affected, that's being driven by some idiosyncratic dynamic. What you'll see is a constellation of assets being dragged down, all connected to the typical dollar financial conditions cycle. And so that's kind of what we're seeing today, whether you look at Bitcoin, the yen, the yuan, other than today's nuanced dynamics of a short squeeze in the Russell 2K. You saw the Russell 2K underperform meaningfully relative to the overall cap weighted market. You're seeing all these edges of the market perform very weakly. And what that suggests is that the private sector may be reaching its limits in terms of the amount of leverage it can provide across financial assets. And that's very interesting because almost always the way this works is the edges get hit first, and then slowly but surely it comes into the market. If we're seeing an environment where expectations are very high, the reality is probably much weaker, and dollar financial conditions are tightening, that's a combination through the second half of the year that is not a particularly good combination for stocks in particular, but also challenging for bonds as they have to receive a bunch of liquidity on an ongoing basis. As we turn to the rest of the world, it's important to recognize that the inflation problem is not dead. When coming into the year, it wasn't just the US that was pricing in a fast pace of cuts. Fast pace of cuts was priced in everywhere in the world. And so far, not too much has happened, in part because this inflation problem has been a bit stickier than most of these central banks would have preferred or desired. Australia is seeing an uptick in inflation in their monthly measures. Canada seeing inflation measures higher than expectations. The UK inflation, particularly in the services side, being undesirably high, with wage growth far outpacing productivity growth. And then, of course, in Europe, where we're seeing services inflation continue to be elevated. So across all of these jurisdictions, we've gotten some cuts in Europe, and the Canadians are, there's some cuts that are going on. But the question is, are we getting a big globally coordinated easing cycle here? The answer is not really. And to the extent that the bond market pricing in the US, but also globally, is a function of expectations of a big coordinated global easing cycle, it's not happening. In contrast, Japan continues to underperform, and really Japan and China continue to meaningfully underperform relative to the rest of the developed world. Japanese inflation has been, has popped up a little bit as it did globally, but it's come down and has been below target for a couple of months now. Growth has been negative for most of the last year, and as a function, the BOJ is not doing much. We saw, what was probabilistically an intervention that happened today on the back of the weak CPI print. Very normal for the Ministry of Finance to come in and try and clean up some speculative positions when the market is offside in one direction. But even with that, we're trading, at something like, 158, 159, which is certainly not all that, all that strong. They got a point and a half out of their intervention and a massive downside surprise in CPI. This is not a currency. It's not a country that needs tighter monetary policy. It's not a currency that is likely to see a whole heck of a lot of support. And honestly, that pretty benign response to intervention and weak U.S. data and a huge U.S. bond move really suggests that the downward trend in the yen persists. And then, of course, we come to China, which is continuing on the path of deflationary depression type environment without sufficient monetary stimulation and fiscal expansion necessary to achieve the type of reflation that has been continually hoped for in the West. And so what you see here, I think summarizes it well. If you just look at the trend of demand, you see that demand is just very weak relative to the pre-COVID trend. That is the core of the underperformance of the Chinese economy. And the outcomes are largely what you'd expect given that, with bond yields probing new lows as the economy remains very depressed, and the stock market basically giving up the vast majority of its gains, except for the real intervention that the real acute intervention that happened in February and March. We're back to stock prices where we were at the beginning of the year. So much for round 3, or maybe it's 4, of the Chinese reflation. With that, off to some audience questions. Let's hit a few questions that were submitted. If folks have questions that they want to get answered, drop them into the Q&A question bar, and we can take a look at them. One question here is, this is from the pre-submitted questions, is whether or not we're seeing economic growth expand globally, whether we're seeing any pickup globally. I think the answer there is that there aren't a lot of signs that we're seeing strong growth or an acceleration of growth globally. What we're seeing instead is maybe that growth isn't decelerating nearly as fast as people expected in certain jurisdictions, like for instance, in either the UK or in Europe. Growth is not quite as weak as many had suspected as a function of monetary policy. But if you look at places like Japan and China, growth is very soft in comparison to sort of their long-term underlying trend growth conditions. And so, I'd overall say we're kind of at this sort of classic late cycle, slow growing environment pretty much globally. The real differences are where strong growth is priced in, like in the US, and where strong growth is less priced in other jurisdictions. Another question here is this an AI-fueled stock market bubble? I think that's, I think a lot of commentators, particularly those folks who are trying to explain why they might have missed the strength in stocks over the course of the first part of the year, will blame it on the AI story. And I think as a macro investor, very often, I look at the market as a whole and look at stocks and bonds and other assets in the context of how conditions transpire relative to what's priced in for growth and inflation. And if you look at it from that perspective, what's transpired in the first half is totally consistent with those dynamics. Totally consistent with the dynamics of growth coming in stronger than expectation. And so I think you can get lost in the specifics of the underlying companies and lose track of the fact that something like 3/4 of the 2/3 or 3/4 of the price expansion that we've seen across the U.S. stock market over the course of the first half of the year was driven by things that had, that were not AI related or the Mag 7 or whatever you want to call it. And so I think this is much more a macro story than it is a micro story related to a small handful of stocks. It's just, by definition, a cap weighted index is likely to see the largest cap stocks outperform as a function of the shifts in the overall stock market. Another question here about if both candidates are interested in juicing the economy in 2025, what's the likely impact of the bond market? There, what I'd say is odds are whether or not a candidate or an administration is able to juice the market at their whim really comes down to whether they control the chambers of government. And if they do, then if government is divided, then they'll be constrained, and if it's not divided, they'll have the ability to pursue more expansionary policies. And so probably in subsequent webinars, we'll get into the details of what the differences in the policies are, particularly as we start to get closer to understanding who is likely to win and what their policies are. Though what I'd highlight on this is it might start to get priced into the market, particularly sort of in aggregate related to overall deficit numbers and how bonds might be positioned. But the nuances of the policies, like, there's no reason to be wildly speculating on that right now. It'll take time to figure out exactly what the policies are and then how exactly they'll be implemented. And so I probably wouldn't try and get too far ahead of that. We'll learn through time and get a finer sense as to what's going on in terms of their view. Turning to some of the questions that folks have asked here today, which one of the questions here is about what Chinese policymakers are doing to deal with their GDP problem. And the main thing I would emphasize there is not much. And this is a very normal dynamic. If you look at countries facing deflationary depression environments, and when I say depression, I don't mean, that unemployment's 50% or that, the economy is contracting at a 10% rate. I'm just saying that's a dynamic. There's too much debt. A depressionary dynamic is one in which there's too much debt, not enough income to service that debt, not enough demand, to grow the economy and deflationary pressures in place. I think that's the sort of dynamic that we have in place. The way that gets defeated is through significant monetary stimulation and significant fiscal expansion. And I'll the exact reasoning behind Chinese policymakers' decisions is a bit above my pay grade. What I would say is that you can just look at their policies and the steps that they've taken so far in order to address the problems that they have. For instance, the housing market problem. They could, and in fact actually did, if you go back to the Asian financial crisis, set up an infrastructure to deal with bad loans associated with both corporations as well as the housing market. They could deal with this problem very, very easily. They could take the bad loans off the banks. They could put them into an AMC. They could inject liquidity and equity into the banks in the same way that the US did in the global financial crisis. And we could basically, they could clean up the banks, clean up the loans, and, provide fiscal support to households related to the housing market through the form of, some sort of check or stimulus related to buying houses, or lower interest rates as a function of that. Those are all measures that could be taken place. And instead, what they're doing is they're trying to deal with sentiment issues, right? They think it's a problem with sentiment. And this is totally normal. If you go back to the US and the financial crisis, if you lived through it, that summer of 2008, it was all conversations about sentiment. Oh, the sentiment's not good enough. Oh, we have a sentiment problem. The problem was not sentiment in the US financial crisis. The problem was the banks were broke. And if the banks are broke, there's a way to deal with that through liquidity and capital. And the problem in China is that the policymakers, for whatever reason, have not recognized that this isn't a sentiment issue that can just sort of be changed by buying a few stocks or announcing policies that represent something like 0.1% of the housing market. They haven't recognized that it's actually a fundamental capital and liquidity problem. Until they do and take the steps necessary, not much is going to change in China. I think there's a general question. There's a question here about sort of the Powell positioning around dovishness, Powell dovishness. And what I'd emphasize on that is that policymakers respond to data, and they respond particularly slowly to data in consensus-driven organizations, unless there's an acute shock situation going on. And while Powell has been dovish in speech over the course really of the last year plus, policy hasn't been dovish. Policy has been relatively consistent. And so what I'd emphasize is just because there's dovish rhetoric does not mean that there's dovish policy. Particularly, policy will be driven by those underlying fundamentals. And when you see a circumstance here, which is that, the labor market has softened a little bit, significantly supported by supply, and inflation has moderated a little bit, but still remains modestly above their mandate, that is the input that's going to drive their decision making. And neither of those inputs suggest rapid cuts, and anywhere near as rapid cuts as what's currently priced into the short rate market. And so I wouldn't get so worried about his language. If anything, you'd actually probably be better off just not listening to him or any of the Fed governors, and be better off just looking at the data and thinking what's likely to transpire in the data. And I'll wrap up with this question, which I think is an interesting one, which is some analysts are saying liquidity will be pretty good throughout 2024. Will that be enough to overcome some of the economic slowness? I think I'd probably address that in two ways. The first is to highlight that that liquidity does not mean economic outcomes, and part of the challenge that exists today, and that the Fed might actually face in a downturn environment, is that there isn't a lot of transmission between how policy is shifting and what's actually transpiring with economic conditions. And when I say that, what I mean is that, we've had a heck of a tightening, and we've had interest rates at this level for 2.5 years, give or take. And nonetheless, nominal GDP has been in the same ballpark, 5 or 6%, closer to 5 more recently. And we've had a modest slowing. But the big picture story here is that basically monetary policy has not meaningfully influenced economic conditions, very slowly influenced economic conditions here. And certainly the moderation that we've seen in inflation, the vast majority of that has been a function of the resolution of supply chains and the fall in oil prices, neither of which the Federal Reserve had any control over, much less so than, much more so than any shifts in demand that were a function of Fed policy shifts. And so when you look at that condition, even if the Fed eases once or twice, like what's the impact on economic conditions? I think it'll be quite muted. I think the real challenge is if we start to get a self-reinforcing downward dynamic, I think the Fed is going to be very challenged to drag the economy back up and stimulate. But that's a story for another day. We're not there yet. Right now, their influence on liquidity conditions is pretty modest. And so if you look at the overall picture, interest rates are likely to remain pretty elevated. Balance sheets, asset holders have extended their balance sheets to buy assets about as much as they possibly can. For instance, if you look at things like mutual fund, cash holdings, and things like that, they're basically at secular lows, multi-decade lows. So where's the liquidity going to come from that? It's unlikely the Fed is going to provide it on the balance sheet side, where the balance sheet is continuing to contract. The government isn't going to spend down the TGA. They've made it very clear it's going to be $800 billion through the end of the year. Like where there aren't good signs of liquidity that are coming. There's de minimis central bank easing and a private sector that remains relatively extended and struggling to extend liquidity even farther. And that's why I see when you look at those market dynamics, those edges of the market, that's where you start to see the edges of whether the liquidity pullback, the financial conditions pullback is starting to affect other assets. And the big picture is it looks like we're kind of reaching the edges about as far as we can go. And today's market action, you don't want to get too cute about today's market action or look too much into it. So I'll leave it at that. Thank you so much for taking some time and sticking around a little bit longer for this month's macro webinar. Thank you so much for taking the time and for all the great questions, and look forward to seeing everybody next month.